Hey, everybody. Welcome back to another episode of the Daily Gold podcast. With me is one of my absolute favorites. I always say when it comes to macro and gold, and you're looking at the two together, nobody does it better than Greg Weldon, CEO of Weldon Financial. And Greg, the first question I have before we get into the gold stuff, I'm really keen on what's going on with the stock market. What's obviously nobody can predict the future, but what's your sense of this recession that we're clearly in, and what could the impact be on the stock market? Obviously some people are hopeful that the worst is already over. What's your sense? What are the things that you're seeing? What are your indicators telling you about this bear market and recession, and how far or how deep they might go?
Well, do we have 3 hours to talk about it? Because there's a lot going on, Jordan. So I will actually backtrack, because everything comes down to the Fed, stock market, gold, and most importantly, the dollar. All right. And the Fed, of course, now is chasing inflation. They could have moved earlier and more aggressively in the beginning, and we would have been further along, but they fell behind the curve. They just did. They thought it would be like 2013, 2012, 13, 14, when inflation came down as the Fed shrank their balance sheet. And that's not what's happened. And they stayed pat, with then record low interest rates at the time, and didn't raise rates because inflation was going to be, and I forget the word they used. It was a different word than transitory. And that's why I found it so funny when they came up with transitory this time. It's the same exact meaning, only a different word. So, but they were wrong this time. It's just that simple. And I said way back in the beginning of 2021 that you had a base effect in energy that would kick in at some point after October of 2021. But the worst case scenario for the Fed would be you get to that point, but energy keeps going up month to month. So the base effect never kicks in because you're not staying sideways or going lower in energy, allowing the calendar to catch up with you, per se. So that kind of threw a monkey wrench into everything. And I think that the Fed just missed the boat. Now, we could talk about why for a long time, because you could say that the Fed was afraid to tighten too quickly or too much, or really too quickly, given that the stock market was very vulnerable at the time, so earlier in the year. So I think that's something to take into consideration, but it also is a tell that, how potentially frightened they are about if the stock market gets loose in the corner and hits the wall, which is very possible. So, within that context, I think that you kind of fast forward to where the Fed is now, and it's like they've gone too far the other way too quickly. And it's like at the time when inflation is going to roll over, and when the economy is headed for a recession, Jordan. We could talk all we want about 2 consecutive quarters of negative growth, all right? I wouldn't say the economy's in a recession right now. I would say it's a bifurcated economy. For some people, it's a pretty bad recession. For the people earning less than the average, income of a household in the U.S., let's call it 60, whether it's 58,000 or 62,000 or 68,000, depending on what measure you want to use, let's call it 65,000. A household big $65,000 a year with inflation in everything is choking to death and having to borrow money to pay the bills. We see the largest consumer borrowing in history in 2022. 2 of the biggest months and the only months over $40 billion in a single month came in 2022. And this is, in my mind, directly linked to the fact that consumers are having to borrow more money, use their credit cards to pay the bills because of inflation. Right. We also know, if you go back to the household survey the Fed does every month, the household credit survey and inflation expectation survey. At this point, when you're talking about, I'm sorry, just got interrupted here. You're gonna have to cut that out or splice it, whatever. What was I talking about here?
The household survey.
Right. When you go to the Fed's household survey, when you look at before the pandemic, all right, the number of people saying that they expected their financial situation to improve in the next 12 months versus those expecting it to deteriorate, in other words, we'll be better off financially in 12 months than we are now, was dramatically skewed towards better off. It was 49% to 9%. So almost 5 to 1, right? After the pandemic, and even to the last report that I saw, which is 2 months ago, all right, it's now weighted 27% to 26% worse off. So you went from a 10-to-1 better off feeling in this country to an even, if not skewed a little negatively. And that's, I mean, you want to cause a recession, cause the consumer to cocoon, cause the consumer to have to borrow money to pay bills. But let's even make it more simple, because here's the facts, all right? This is not opinion. This is a fact. Every time you have seen the food at home inflation go above 6% year over year, a recession has happened within 12 months. Right now, that measure is at 12.6. 12% increase in food. And Jordan, this is not just the U.S. This is everywhere. Food prices are through the roof. You're talking about this thing can kind of be sticky and continue, whereas energy, you've had a correction in energy that might already be over. But let's get back to the Fed, because now I think you're on the cusp of a change in the narrative from fighting inflation to protecting growth. And that's big. If you look at the things that Powell said this week on Wednesday, I mean, they're subtle, but they're crystal clear. What he says, first of all, we have two sets of data, monthly data coming before they meet again. So you have two retail sales, two consumer confidence, two CPI, and two employment reports. If you get a negative employment report, the Fed will not be hiking rates in September. I would sit here and take bets that the odds of a rate hike of another 75 basis points, which Powell floated in his press conference, is less than the chance they do nothing. All right? The odds that they do nothing are not nothing. I like to do this to play on words. Right? And here's why. Because if you look at what Powell said, and I'm going to quote him, because and any of your listeners are free to contact me by email to get this two-part special report I did on the Fed. The first one breaks down every word Powell said. The second one looks at the impact on the markets. What he said was, another large hike may be appropriate in September, but that's a decision will depend on the data between now and then. I think it's time that we go to a meeting-to-meeting basis and not provide the type of clear guidance we've provided on the way to neutral. Now, this is a really exposing comment, because he just said on the way to neutral, like we're ending this because we've gotten to neutral. All right? You can make a case that based on the Fed's projections, 275 is neutral. Why do you say that? Because they expect inflation to come down to 2.5. Right? So, I mean, I don't think that's going to happen. I think you're talking about inflation may come down to 3, and maybe they go one more time. But the fact of the matter is the ground is already shifting. It's shifting towards less tightening. All right? The problem is twofold. Number one, balance sheet shrinkage has only just begun. You're still running at a $700 billion annualized rate. Well, that's going to go to negative. That's going to be a problem. It's a tightening in monetary conditions. So what can they do to potentially offset that? Jordan, it does now, and it always has come down to the dollar. All right? I called this piece that I did today singularity, because the single fact that you need to know is very simple. Stronger dollar equals weaker stocks. Weaker dollar equals stronger stocks. And you can throw commodities into the mix too. And that's where we're at, Jordan. I think the dollar has peaked here, at least on a medium-term basis. Looks very heavy, very extended technically. You know, when you talk about the rate differentials, you know, you've had this push in the dollar because actually the German 2-year note is down 100 basis points from its high. I mean, you know, the U.S. is just coming off 3%. So that has been a very dollar positive backdrop that I think is going to dissipate. And from that perspective, and I know that a lot of people out there that know me and have listened to me for a long time will gasp, will just be like, they're going to want to replay it to see that they heard what I'm about to say. Right here, stocks are a medium-term buy. So because I think the dollar's turning. Gold's a medium-term buy. Copper is a medium-term buy. And not only that, we could talk more, and I don't mean to make this answer sound so long, but again, if we had 3 hours, we could cover everything. Well, the dynamic in gold is speculators are short, all right? Well, they're short. They're net long. They're net long, and the gross longs are smaller than they've been in years. They're not net short gold, but they are net short silver. They are net short copper, all right? Copper open interest is at like the lowest level we've seen in years, and every time copper open interest gets to this level and specs are short, it's a major rally after that. So, and when you talk about the commercials, you talk about, J.P. Morgan, they've just taken in a whole boatload of gold into their warehouses. They're buyers on this dip. Commercial accounts are buyers. J.P. Morgan is a buyer, and they're stashing the stuff. Why? Because we see, or anyone that's really paying attention, anyone that dissects, the syntax, the verbiage, and the meaning of every word that Jerome Powell used this week, understands that the shift has started, and it's a shift towards less tightening, and that's going to be the medium-term impact on the markets.
Okay, so a shift to less tightening. Let's presume they'll do that at some point. Let's presume it comes sooner than people think, which I think you're hinting at. I mean, if that's the case, how long is a Fed pause, or are they forced to ease immediately? I mean, how the transition between less tightening to eventually easing, what do you see there?
I don't know. I mean, that's the 64 million, or if you're playing the lottery, $1.1 billion question, right? I don't know. I think that there'll be a time frame where, they're going to see this, the Powell Fed is so deliberate, it's not even funny, and maybe too much so, right? There needs to be some mystery. I mean, I've been in the business 39 years. I remember when sitting on the desk at Lehman Brothers in the World Financial Center, waiting for the 11:30 announcement what the stop-out rate was in the Fed funds, market in terms of the liquidity add, liquidity drain that the Fed might execute on any given day. All right, you had to read the tea leaves. They didn't tell you what they were going to do like they do now. I almost think like it's too transparent. You got every guy out there wants to be on TV. I mean, these are Fed officials. They're not celebrities, for crying out loud. This whole, obsession with celebrity is just mind-blowing when you see, YouTubers and TikTok people that are like, these celebrities. And that ties right into the stock puppet strategies that I think we talked about the last time I was on the show when I did my year ahead piece talking about crypto and talking about sock puppets and talking about pets.com in 1999 and how it was all about the sock puppet. That's all they had. It's like Doge and Shiba. Doge has a picture of a dog. It's all it has. It's worthless. And now people are coming to that realization, right? It's very much like 1999, 2000 in that context. And we caught the downside of the NASDAQ beautifully, right? But I think the NASDAQ hit retracement levels, all right? Even the S&P just hit the 38% retracement of the entire rally from the pandemic low, all right? And you have the dollar turning. And I'll tell you what, you really should, anyone out there that's listening and want to see the charts that I put together for this two-day special, I mean, they're really specific. When you compare the dollar to the stock market, it's just as simple as I'm making it. And when we talk about how are they going to proceed from here, the next thing is to not hike rates. All right, so that's going to be the next thing. Will they ease immediately? No, they won't. All right, because what he's telling us is that some decline in consumption, some decline in final demand is necessary to achieve their goal. All right, but they want to do this without hurting the strength of the labor market. So I think from here on out, it's like you've just shifted from inflation to the labor market data is the most important. I'm not saying inflation is not important. I'm not saying inflation couldn't rise. I'm not saying inflation couldn't throw a monkey wrench in all of this. It absolutely could, especially if the dollar now starts to roll and commodities have had their correction and it's over. I mean, look at it here. Copper, soybeans, cotton. I mean, they're all coming back. They're all coming back off of retracement levels. The technicals are just a beautiful thing. And you have a shift in the Fed, so you got the fundamentals now, too. The question then becomes, how long will they wait? Or will they make another mistake? And, who knows? I mean, maybe you get two huge inflation numbers and two huge employment numbers, and all of a sudden the Fed is hiking 50 or 75 basis points in September. I think the chances of two huge employment numbers has really lessened because of the increase in layoffs and because of the move in the ISM employment indexes, which are, in the case of manufacturing, negative already. So I think the writing's on the wall. The question is, how quickly does the Fed react? This is a very slow to react Fed, and I think they will be very slow to react, and that's where the policy error comes, because they may be slow to act, and that may cause some turbulence in trying to trade these positions that we're talking about. But at the end of the day, the longer they wait, the more powerful it is when they have to move, and they will, because you will have a recession, and the stock market will have a rally, but then it'll come under pressure. Let's not forget the bond market. Let's not forget that you have now, again, it's like $656 billion now is the rolling 12-month increase in the balance sheet. That will go to zero, and it will go negative. At the same time, the Treasury's public borrowing needs will be a record high this fiscal year of over $2 trillion. A $3.5 trillion flip-flop in supply-demand in bonds, I'm not sure the bond market can handle that without rates going up no matter what the Fed does. So that's kind of the way I see it playing out. I'm not saying I expect this or anything, but I could easily, this is what we do. We create all these scenarios. What if, what if, what if, what if? This is what the great hedge fund guys in New York do, and that's where I learned. What if, what if, what if? So you've talked it through, and when you see it start to happen, you recognize it, and you know exactly what you want to do. So I can see a situation here where the economy starts to roll over, inflation at least flattens out, all right? You have a chance to get a base effect rollover, but not till March. So it's going to stay high. It may flatten out, though. It may not keep increasing. You may see a bunch of, high 7s and low 8s for the next 3, 5, 6 months. All right, that may be enough for the Fed to say inflation is not rising anymore, it's not accelerating anymore, and pay attention more to the labor market. So I could see them waiting. I could see them coming back with easing. That is less effective, especially in the bond market, if bonds are getting whacked. And if you're easing, or rather if the economy's tanking, you have Democrats in power, they're going to come with fiscal spending, which will only put more pressure on the bond market. So I could see a situation where, bonds get loose and the Fed can't control it, and that's what whacks the stock market, and they're trying to ease, and it's not working. It's kind of a stagflationary type of environment where the Fed's, monetary steroids don't have the same effect. When you're a steroids abuser, at some point you look strong, but your internal organs are failing. That's where we're at right now, as far as I'm concerned, with the monetary policy, with R-star, with inflation expectations, with the fact you can't have negative rates. Europe tried it. It didn't work. It was a disaster. It worked the opposite. It was a real, liquidity drain. So we'll see what happens. But I can tell you this, Jordan. I think the opportunities and how exciting it is to try and handicap these markets has never been, more stimulating to me, and I think potentially more lucrative.
Okay, let me. So let's. Maybe you can handicap one more thing for me before I let you go. Let's talk about the gold market, because gold's. It's obviously having a good rally here. At that major support. I guess I have two questions. I'll give you one first. What does gold need to be able to break out from above 2050 and really run? Because to me, that's really the. If we're going into a new environment for gold, that has to happen in my opinion, for gold to break out and run away. Otherwise, you're just in the same scenario. You're in the same scenario as the last 5 or 6 years, where the Fed eases at some point. Gold's able to rally, but not break out because the economy is, doing well thanks to Fed easy money again. So I guess I talked over the question, but I guess talk me through how gold, or what it needs to be able to get through 2050.
Sure. It needs a lower dollar. It's that simple. And frankly, I think we've had this discussion before, whether it was kind of on the air or off the air, that, people kind of are like, upset with gold or frustrated with gold. And I do understand that, because it's been frustrating. I've been frustrated with gold. But if you step back and take emotion out of it and take your desires out of it, then the market's never necessarily going to give you what you want. Honestly, I've been doing this for so long. I have learned the lessons you need to learn. And I understand that the second you think you know something, the market's going to teach you that you don't know anything. And the other side of that is the market will screw the most people possible at any time, at any given time, right? In that case, you need a lower dollar. And I would go back to the point I was making, which is being frustrated at the dollar is one thing, but when you consider that the dollar is barely off the highs here, $200 off the highs, when the dollar is at, and let's take it back to the last time it was rising through these levels, not coming off, okay? You're talking about a 25-year high in the U.S. dollar. You're talking about new lows in the CEW, emerging market currency ETF. You're talking about gold in a lot of currencies at record highs. So when you talk about gold, it's so U.S. dollar centric, and the people in this country feel like, the dollar is the only currency that matters. And, I don't necessarily disagree with that if you live in the U.S. But the point is, you're trying to handicap gold, you got to be more, broad in your view. And I would say that gold has held up spectacularly in the face of a massive secular breakout in the dollar. Dollar's gone from 88 to 110. That's a huge move. It's up at its peak. It was up 17% year over year. That's a big move for a currency. And it goes back to the old ERM days when they were trying to, get it positioned to have one currency. And you got to bring the Italian lira and the Spanish peseta and the escudo and all these, not the escudo, that's Ecuador, but all these other currencies into the mix. They had the ERM, and it was the bands. And if you got outside of 15% movement on your currency against the basket of European currencies, the central bank was mandated to intervene until it knocked it off at that level. That's where the dollar's been. I mean, that's another thing, too. 3 things are now in place. The yield curve inverted in the U.S., the 32-year. It's come back a little bit, but it inverted. Food at home inflation was above 6. And the dollar was up more than 15% on a year-over-year basis. Those 3 things combined make a recession a 99.999% chance based on those 3 factors alone. So in the context of what gold needs, it needs a lower dollar. It needs the Fed to shift. We saw the beginning of that this week, but it's going to be laborious to some degree because the Fed, I think, is, they need to look inflation vigilant. On the other hand, you get a bad employment number, everything changes, and that could happen immediately. And again, that's why, I can't sleep past 2 o'clock in the morning, man, because I'm so excited to get up and see what's happening every day. And I think, for the long-term investors, this is not a bad place to buy gold. Could it go to a 14 handle for a short period of time? It could. Yeah. Dollar could keep going up. The Fed could make another policy error. They've already made 2 just in the last year. So they could make a 3rd, and that would be a problem for gold. On the other hand, I think that the writing's on the wall. I think if you read the tea leaves of Powell's comments, the narrative is about to shift in a more mainstream fashion, and that's what you need. You need recognition that the narrative is shifting. And when that happens, the dollar will get whacked. I see the dollar falling back below 100. That's like a 5, 6, 7% move to the downside. That'll stoke gold. Whether it can get to new highs, probably going to need the Fed's assistance. And I think the other thing I would say, it's not like, you've been in this little range. It's somebody's stepping on gold every time it gets up to 2,000. You think when you have an inflation environment where the Fed is seen as behind the curve, that the Fed and the Treasury are going to say, okay, yeah, let's let gold be, above 2,000 making headlines. There's no way, man. There's no way they were going to let that happen. All right, but they're buyers now. That's huge. The commitment of traders is a major tell here in terms of gold. And it's problematic because the technicals are bad. I mean, they're bad, but they're not yet broken. I mean, you look at it's like 1673 is the major breakdown pivot. Below this week, 1678, and it's rallied. You held where you needed to hold, and that's right off one of the key moving averages too. So you held where you need to hold. You've been holding in a spectacular fashion. If you get the dollar on the run and you get the Fed back in play, all of which could happen by year end, gold will be higher.
Okay, Greg, thanks for that. Before I let you go, please tell our listeners how they can get that free report and also how they can subscribe to your service.
Sure. Thanks, Stuart. I appreciate that. It's at weldononline.com, and it's W-E-L-D as in Donna, Weldon, O-N as in Nancy. So weldononline.com is all one word. You can sign up for a free trial to the research, which is 3-4 days a week. This week it was 5. Depends. I mean, I do this by myself. I don't have staff. I don't have even like an assistant outside of, someone that runs the business, Caitlin. So you get 100% of me too. I don't hold anything back. There's one product. It covers everything. I cover all this stuff, foreign exchange, fixed income, all the ag commodities, energy, metals, everything in global macro and all the stock markets. I would also add, and something I've never promoted on your show because we hold it very close to the vest, but we are accepting new money under our CTA, registered Series 3 with the NFA, for accredited investors only. And we have had phenomenal returns over the last 3 years. I mean, we have really nailed this, and I really feel like I have my finger on the pulse. I really feel like I have kind of crystal clear vision here in terms of what I think is going to happen next, and that has been true. I mean, it's kind of been true for 20 plus years since I started being independent, and certainly my career in the hedge fund, track record is spectacular there too. And I think it's important for individual investors because the days of passive investing, index buying, and buy and hold in stocks is probably over. You might get one last run up here, but that's going to be it, man, for a while, for several years, I think. People forget. Again, old and decrepit me, it still it still works out every day. I remember the days when the stock market went sideways for years. So I mean, it's not like, and it's funny, you watch financial media, you watch CNBC and Bloomberg, and it's like these guys are like, oh, is the correction over? We're ready to make new highs again. It's like, guys, the stock market doesn't make new highs every other month. And if it doesn't make new highs every other month, it doesn't mean there's something wrong. I mean, this whole setup where everyone has a vested interest to be bullish is mind-blowing, where the narrative is so one-sided. And I think that down the road, you have big problems for the stock market, from a fundamental perspective in terms of the 50-year credit bubble that is bursting right before our very eyes. So in that vein, I think that people are going to need guys like me, whether it's me and maybe I don't work for you, but somebody else that does this, that can be long, short, all of these markets, the futures markets. If you know the math, if you have respect for the math, they are a phenomenal tool. They really are. And I invite anyone to contact us that's a accredited investor to have a discussion to see whether we're right for you and whether you're right for us, because we don't take money from just anybody.
Okay, Greg, on that note, thanks so much for giving us an update and providing your analysis. I really, really appreciate it. And hopefully we can do this again in the coming months after something changes.
Sure, Jordan. I appreciate the opportunity to participate, and you do a great job. So kudos to you too.